The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The week for equities ends just like it started, on a down note. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in New York, in the United States. The S&P 500 down by 1% on this Friday. A lot of that pain coming through when it comes to big tech, as you can see, after we got that disappointing read from Oracle and from Broadcom. I will just remind you, this is a week where we did hit a record high, but certainly feels far away on this Friday. The Russell 2000 also in the red deeply here, down by 1.3%. Not helped at all by the sell-off that you're seeing. The 30-year Treasury yield higher by 5-6 basis points right now. Some interesting Fed comments coming through. We're going to get into all of it, Romaine.
Yeah, we are going to get into all of it, but we have to talk about some of the questions out there right now about the scale of the AI build-out, the financing to facilitate it, and the potential return on that investment. Remember, that had already led to a 5-week sell-off in tech stocks. Well, today, you throw another log on the fire of AI skepticism with the news that Oracle is said to be pushing back completion dates for some of its OpenAI data centers, and Broadcom holding off on giving an annual AI revenue forecast. So that means the 5-week AI sell-off is now a 6-week slump. Investors now taking a more fundamental and, quite frankly, a more down-to-earth approach to the AI trade rather than putting their hopes and prayers into those moonshot expectations of earlier this year that conveniently ignored basic financial fundamentals. Moonshot expectations that had pushed AI stocks to record high after record high.
Given valuations, it makes sense for people to say, look, AI might be absolutely transformational for the way business is done a few years from now. It can absolutely increase productivity. But who are the winners? I think given valuations, you might want to diversify who you think might end up winning.
And of course, trying to value these companies, at least through traditional discounted cash flow models, that's getting harder than ever with the rise in Treasury yields. No coincidence that the sell-off in high multiple tech names since late October coincided with benchmark yields rising more than 25 basis points. In fact, since the NASDAQ 100's October 29th record high, Microsoft and NVIDIA are down 10%. Dell and AMD have dropped about 20, Oracle down 30, CoreWeave 40, and power stocks also getting dinged. Constellation Energy in correction territory, and Vistra and Vertiv right now, Katie, in bear market range. Are you going for the optimistic or the pessimistic?
I am. Look at this happy chart I have behind me. I thought it'd be interesting to take a look at how the global stock market is performing. Of course, we spent a lot of time talking about what's going on in the United States. And as I mentioned, we did see a record high this week, but take a look at the all-world index from MSCI behind me. You can see that we saw a similar drop when it came to early April with that tariff liberation day back and forth that we saw from the Trump administration. But look at the recovery since then. We are sitting currently right now at all-time highs when it comes to this index. A good reminder that it's not just the U.S. that we're seeing this performance from. You're also seeing it in Europe. You're seeing it from emerging markets. We've certainly heard a lot of optimism there, as well as when it comes to Asia, Romaine. The question is, what is going to be the catalyst to keep the party going in 2026, especially when you see a lot of central banks around the world, particularly when it comes to developed markets, maybe backing off from that easing mode?
Well, Mona Mahajan joins us right now to kick us off to the close. Maybe we can get some insights out of her, head of investment strategy over at Edward Jones. Mona, great to see you here.
Great to be here.
I'm not sure how you came into 2025 in terms of your optimism, pessimism levels, but I am curious as to where those optimism, pessimism levels are for you, at least with regards to equities here with 20 days left in the year.
Yeah, look, we still think it's a fairly benign backdrop. We're looking at a 2026 that's probably still giving us a 2%-ish economic growth picture. We're looking at a Fed that is still likely heading towards a neutral rate. We're looking at an earnings growth picture that remains double digit. But keep in mind, there's risks to the story. There always are. And that includes, to your point earlier, AI uncertainty and maybe even a little bit of lingering inflation. So two things we're watching closely. With regards to the AI uncertainty, is that uncertainty, or are we going to be talking about a material pullback in the AI tech trade? Yeah, look, as we're exiting 2025, this is now year 3 of growth outperforming value, of tech and AI leading the charge forward. As we look at what's happening to the business models of some of these companies, they are getting more debt heavy. They are going from asset light to asset heavy, a lot of infrastructure, CapEx build out. And so we do think some of the margins and some of the valuations may come under pressure. Now, as we think about it, one of the things we say, don't fight the Fed, but also don't fight earnings growth. And we look at earnings growth for 2026, double digits, But the good news is it's coming from tech and non-tech parts of the market. So there is this case to be made that you should have some innovation exposure, but you should have some other parts of cyclical and value in your portfolio for the year ahead.
Well, I want to talk about tech a little bit more, and I want to zoom out here because you made an interesting point that you think about tech, they're going from asset light to asset heavy. That is a sea change. You think about especially during the pandemic era, it was more the fact that, they had a lot of intangible value. That was one of the big draws of tech. Is the nature of investing in tech changing here, or is this something that maybe isn't quite structural?
Yeah, I do think markets have been smart in sniffing out those players that might come under pressure. So you think about a company like Oracle, already high in debt, has been taking on more debt to finance some of this CapEx spending, and you see what's happening in some of their CDS and multiple and valuation concerns there as well. So markets have figured that out. Now, a lot of the Mag 7 have been extremely cash rich. They can actually probably do a lot of the infrastructure build out from cash on their balance sheets. But companies like Amazon, Meta have been taking out a little bit more debt as well. So I do think the asset heavy nature, while it's still not going to be a complete burden on the balance sheets, it might give investors pause on how much they're willing to pay from a multiple or valuation perspective. So that's something we're watching closely as well.
Well, when it comes to the blue chip tech companies that can probably, like you said, pay for a lot of this build out from free cash flow, I was having a conversation with Rick Reeder actually at an ETF event upstairs in the Bloomberg building yesterday. And he said when it comes to a lot of these tech names, those in the AI build out, the big question that he faces, or at least one of them, is whether you want to own exposure to that name in equity or in debt. And I wonder, for some of these high flyers, how do you approach that question?
It's a great point because, look, we do think from a debt and really from a yield perspective, if you look at investment grade bonds today, they actually offer an interesting yield above the 4% or 4.2% Treasury. And a 4.2% Treasury is actually at a near 15-year high. And then you add on that some of these corporations that can really, offer you some interesting yield with a very strong balance sheet behind it. We do think there's some interesting opportunities coming in 2026 in the bond space. So we like that, especially if you're in retirement, near retirement, or just looking for income. When you're at 5, 6, 7% yield return, you're actually kind of close to what you want to be from an ongoing return perspective, and outpacing inflation, by the way.
But with regards to that strategy, do you see more opportunity on the corporate side than on the government side?
Certainly on the investment grade corporate side. We're still a little hesitant to go full high yield. Spreads are very tight. There could be volatility, we think, as we play out in the year ahead. But we think both government and corporate, IG corporate, very interesting yields here. And 10-year, I think, is in that bucket as well.
Interesting. Well, let's wrap the Fed into this conversation because you think about the sell-off that we're seeing on this Friday. A lot of it can be traced back to what Cleveland Fed President Beth Hammack said, that she would prefer interest rates to be slightly more restricted to keep putting pressure on inflation. You think about this Fed, it seems like 2026, one of the stories is going to be the division as to what should come next when it comes to their rate cutting trajectory. Where do you fall currently?
Yeah, it's a great point. So, we think inflation will land somewhere in this 2.5% range. And traditionally, Fed funds is about 100 basis points above inflation. So 3.5%, or maybe it's 75 to 100 basis points above inflation. So we think that 3.25 to 3.5% feels like a good neutral spot. We're close to there already. 1 to 2 hikes will get us there. 1 to 2 rate cuts, will get us there. And I do think the Fed, and especially Jerome Powell, would like to leave this Fed in a neutral position so they have the opportunity to pivot as they need going forward with the new Fed chair.
And no concerns here about kind of the lame duckishness of his term over the next 5 months?
No concerns yet. We're watching it. Look, we know some of the key players that are named as potential replacements for Jerome Powell. We do think if the Fed comes under any question as per its independence, markets are actually going to start blowing out yields on the long end. And that's the opposite of what this government really wants, which is lower yields. So that's a good point.
All right, Mona, I have to leave it there. One of the best in the business, Mona Mahajan, Head of Investment Strategy at Edward Jones, kicking us off to the close here on this Friday afternoon. When we come back, a conversation with Priscilla Sims Brown, the president and CEO of Amalgamated Bank, the largest union-owned bank in the country. We're going to get her outlook for 2026.
Plus, OpenTable's Debby Sue is dishing out the deets when it comes to restaurant demand. She'll wrap up the year in reservations and tell us what she expects to see in 2026.
And then we're going to bring it home with real estate and a real estate icon, Ryan Serhant, on his expectations for the Manhattan market. And of course, we're going to take a look at season 2 of his Netflix show, owning Manhattan. All that and more coming up in a bit. Stick with us. This is The Close on Bloomberg.
Analysts expecting another year of record highs in 2026. Goldman strategists writing in a note today that S&P profits could jump 12% on AI-fueled earnings and economic growth. Our next guest has been called one of the most powerful women in banking, and she says that affordability concerns and interest rate uncertainty could make investors and businesses more disciplined in the year ahead. Joining us live is Priscilla Sims-Brown. She is the president and CEO of Amalgamated Bank. Great to see you in person.
Thank you. Good to be here.
Let's talk about affordability, because we've seen it come up in recent elections. We know it's going to be a big conversation in the midterms, and it's a conversation that every family in America is probably having right now. So talk us through what discipline could look like on the part of consumers and businesses next year.
Well, I'll first just say that it is a topic that most people agree on, and which is an interesting part of this. I think no matter where you are on the spectrum politically or in other ways, you agree that affordability is a concern. And that requires, I think, companies to think differently about serving not just the most affluent, but those who are also underserved in traditional financial sectors. And so I think that's an opportunity for businesses to really think about low and moderate income families, and also the organizations that serve them well. And financing, providing access to capital to those organizations and individuals is, I think, an important opportunity, which also is great for profits because it's an underserved community, but it's something that helps everyone. And then for individuals and families, I think the opportunity to think differently about how we spend will make the difference.
I am curious about just actual activity that you're seeing amongst clients with regards to borrowing. Are they feeling, I guess, A, are they confident enough to borrow? And more importantly, do they have the capacity and the creditworthiness at this stage in the economic cycle to do so?
So two things I would say about that.
Yeah.
At the consumer level, which is not the largest part of our business,
right.
but at the consumer level, there's an opportunity to think differently about how we underwrite.
Okay.
Because there are ways in which people demonstrate their creditworthiness that may not be reflected in credit scores. They do it through the payment of all sorts of things: your cell phone payments, your rent, your union dues, your all the many ways that you are diligent in responding to your debts.
But that's been a hallmark of the bank pretty much since its inception.
That is right.
Okay,
that's
has that changed at all, or has that intensified in some way?
It has intensified as the wealth gap has widened. But the bigger opportunity for us, the one that we see that's really important, is that when you think about the intersections of things like resilience against climate disasters, and also the economic impact of healthcare and medical bills and such. When you think about all of those intersections, there are opportunities to address the needs. For example, we are really engaged in a product called CPACE, Commercial Property Assessed Clean Energy. This is just a way that property owners can receive loans for the work that they need to do that may create greater resilience, whether that's a solar panel, whether that's a better window, whether that's a heat pump installation. And that's done both at the residential and consumer and commercial level. And lending into that is a huge opportunity for financial services firms, but is also something that addresses resilience that individuals and businesses alike can benefit from.
Well, I'm taking a look at your 2026 market outlook, and you do highlight the energy transition as, a defining economic engine here. And I wonder, how that conversation wraps in, especially when you think about the different sectors that are impacted by that transition.
Yeah, the opportunities in energy are great, of all forms. There's simply more demand than there is supply. And certainly with clean energy being less expensive than most forms, there's a particular opportunity there. So we see that in battery storage, geothermal. About 40% of our lending, in fact, is climate related.
Are you seeing a lot of competition for those loans? Meaning, are you up against other regional banks, or up against direct lenders, private credit folks?
Sure, there are a number of people getting into the game, particularly at a time when there may not be as many federal opportunities for those projects. But again, still got supply that outstrips, demand that outstrips supply, which then makes it still an attractive
So it doesn't affect your underwriting standards?
Not at all.
Yeah.
Interesting. I do want to talk a little bit about interest rates, because you think about the rate cut that we got this week. We know that that was consensus, but there is a lot of quabbling being done over what exactly the Fed's trajectory looks like in 2026, whether or not we are going to see rates meaningfully come down. What impact have you seen when it comes to some of the clients that you work with, some of the businesses that you lend to, the impact of these higher rates that might not be coming down as quickly as some might have hoped?
I think certainly, while there's a little bit of our diverse opinions on this, I think the expectation is that there will be a lowering of rates next year. I think the uncertainty causes people to pause. Certainty changes that, so you'll see more investment and more activity as people have greater certainty around that rate cut. For us, it's really, we're fairly rate neutral. We're slightly better if rates are up, but it doesn't matter a lot. What's really important to us are deposits, how those are running. We're really pleased with that. How lending is going, and we're really pleased there. And then credit quality. Those are really the three most important things to us, more important than rates themselves.
But with regard to your margins, net interest margins, I mean, that's still a rate story.
Yeah,
have you made adjustments in anticipation of rates coming down?
We are, we're a little bit unique in that this bank is fairly deposit rich and a fairly high percentage, so we have low cost deposits. A fairly high percentage of our deposits are related to segments which are moving pretty quickly and therefore are not as rate sensitive.
All right, Priscilla, great insights, and great to have you here on the program.
Great to be here.
And love to have you back sometime. Priscilla Sims-Brown, President and CEO of Amalgamated Bank, as we continue to count you down to the closing bells here on this Friday afternoon with a look at some of the big movers, and one of the biggest of them all is Broadcom, down 12% on a disappointing sales outlook. We're going to discuss with an analyst who covers a stock that's coming up next here on The Close. This is Bloomberg. All right, time now for our top calls, big movers on the back of analyst recommendations. We start with Roblox and a downgrade of JP Morgan to neutral. The price target going to 100 from 145. The analysts seeing Roblox taking a bit of a breather in 2026 due to headwinds hitting user engagement. Those shares down for a third straight day. Next up, Restoration Hardware, RH as it's now called. TD Cowen cutting the price target to 200 from 265, but sticking with its buy rating, saying that the price target cut really is just a note of caution post earnings, but the analyst still sees the shares potentially working again. They're working today, up 7%. And finally, how about Citigroup here? JP Morgan raising their rating to overweight, upping the price target to 124. The analysts banking on Citi benefiting from a solid economy and strong markets-related activity. We should point out Citi shares, which had actually been up a little bit earlier in the session, now down a fraction of a percent, an 8-day run heading into today. Those are some of our top calls. Let's turn to Broadcom. Those shares down more than 12% after the chip maker, well, kind of didn't give a sales outlook and then said that its backlog for AI, well, came up a little bit short than what analysts were looking for. Let's bring in Will Kerwin, Senior Equity Analyst for Technology over at Morningstar. Will, first, let's start off. I didn't actually think the numbers were all that bad. Why do you think we're seeing such a negative reaction in the shares today?
Yeah, and Romaine, Katie, great to be with you today. We also didn't think the numbers were that bad. We actually really liked the numbers, and we liked a lot of the forward-looking commentary that management gave. So we see this market sell-off today as a little bit missing the forest for the trees, some nitpicks maybe around margin, maybe around backlog, but really ignoring what we focus on, which is that there is a grander picture here of accelerating AI demand, and we think that's constructive into the long term for Broadcom.
We'll talk a little to the fact that, they held off on giving an annual AI revenue forecast. The comments from the CEO were that it's a moving target, and it's hard for me to pinpoint what 26 is going to look like precisely. One of the reasons why you're seeing shares startled to the extent that they are today, Will, it seems like not necessarily something that you're all that concerned about.
Definitely not. Well, they did not explicitly guide to full year AI revenue. they've really been leaving what I've been calling a trail of breadcrumbs and letting us analysts figure this out. So first off, the Q1 guidance for AI was above our expectations, a little bit above consensus. And then there are these massive purchase commitments coming in the second half of 2026 that we think will create an acceleration and a surge in revenue. There's $21 billion set to come in from Anthropic, which is the company's fourth custom AI chip customer. And then the company announced a fifth customer, yet unnamed. I've seen rumors that it may be XAI with its own $1 billion order. So we see this as a good first half and an acceleration and an extremely strong second half.
Revenue growth, order backlogs, those are good things, Will. But as we kind of saw with some of the issues with investors souring on Oracle's earnings report, there are a lot of questions about how much money is it going to take to actually fulfill those orders and whether that money that's needed eats into the profitability of all of those sales. Is that a concern?
It's a concern longer term. The way I've been kind of describing this AI hardware infrastructure is that in the short term, in the next 1 to 2 years, everything is supply constrained. And we think that is going to lead to continuing strong demand and strong growth. And long term, over a 10 plus year period, we see this as a transformative technology that is really going to be the end all be all in tech investing. Now, in that medium term, it could look a little choppy. We could see a correction in what that growth looks like. I talk about this as kind of the slope of the curve, maybe a flattening at some point in the future. But really, over the next 2 years, 2026 and 2027, we see a lot of upside for Broadcom.
And Will, we have less than a minute left with you, but I wonder how much of the share reaction that we're seeing right now on this Friday is a case of high expectations. I'm taking a look at our preview piece on the Bloomberg terminal, and it was Broadcom is primed for disappointment after its blistering 170% rally since those April 4th lows. I wonder how much that plays into it.
I think it's all about expectations, Katie, and especially given that Oracle had reported just earlier that day and shares were down. I think the market was looking for really anything to nitpick in these numbers. And again, there was maybe some disappointing margin guidance and again, a lack of that full year AI guide. But really, we think those are nitpicks, just what I said, and that the grander picture is extremely positive.
Certainly a lot of nitpicking going on today. Will, great to have some time with you. That is Will Kerwin of Morningstar. Now, coming up, we're going to be speaking to OpenTable CEO Debby Sue. Don't go anywhere. This is The Close.
.30 p.m. in a Long John weather, New York City. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're keeping an eye on the markets.
It's so peaceful out there, yet it's so brutal and cold.
Yeah, your face hurts. I actually went for a run this morning and
outside?
Yeah, I felt super tough.
Why did you do that?
It was just me and like the birds. No one else was out there. Anyway, let's talk about restaurants. I know
and
that
even
you're
the birds probably didn't want to be out there.
You're a big foodie, Romaine. OpenTable is out with its 2026 dining trends report.
Yes.
One of the key stats it found was that 55% of Americans think that they'll spend more on dining out in 2026.
That surprised me.
Well, you have to wonder, is that just because things are going to cost more or because we're going to be eating out more?
That's a good question. But yeah, I thought it was like, because it seems like we talk so much about people pulling back. It also gets into this idea of the kind of K-shaped economy. Obviously, OpenTable kind of traffics in restaurants that are a little bit more upscale than some of the people that we have on our show. But I don't know. I think there's somebody who can maybe help answer that question for us.
Shall we speak to her?
How about that? That's a segue.
Yeah. Joining us to discuss the trends she's seeing in the restaurant industry.
There's Katie.
No. Don't I usually do this?
This is a Friday. You do.
Okay.
Was my name there?
I'll just keep going. Debby Sue, she is the CEO of OpenTable. She joins us right now. Debby, such an interesting report. There's so many different stats that we can dig into there. But let's start with that one, the one that we just showed up on the screen there. 55% of Americans saying that they plan to spend more in 2026. So I'll ask you the question I asked Romaine. Is that because things are going to cost more or because we're going to actually go out and spend more at restaurants?
I think it's both. And great to be on, by the way, and happy to join this little party on a Friday afternoon. But I do think it's both. And I'm going to start with your second point. I do think people want to go out. We've seen that year over year since the pandemic. People continue to prioritize the experience of dining out in their household P&L. I think that's one piece of it. People are craving connection. They want to be taken care of. And I think that they want to support their local restaurants. I think all of that is wonderful. I also do think there's a part of it where, I don't, Romaine knows this. I'm not a great cook. I don't do it often. I did try during Thanksgiving. So, we went to the grocery store, we bought all the things. I was astounded by how much things cost. And so restaurateurs are so scrappy and innovative and resilient. And oftentimes we've seen, even with labor shortages, supply chain interruptions, inflation, they have not pushed that full cost that they're seeing onto their diners.
Right.
So oftentimes going out to eat could be a better deal. So I think it's both of those things.
Yeah, it's interesting. And you've seen that really across industries, not just in restaurants. Basically, companies taking on and eating some of the cost of those higher prices. But I want to talk a little bit about generational differences here, because I'm taking a look at the consumer segmentation breakout, and millennials actually plan to dine out 14 times a month. That is the highest of any generation. Is that usually the case, Debbie?
We haven't seen it be this high in one particular demographic, and it's funny because when I saw that stat, I was like, do I count in that? So I had to Google that and check. Yes, I indeed am a millennial. 14 times is very high, but if you think about maybe on the weekends, brunch, lunches, once or two during the week, and then a few dinners. If you break it down that way, it's not that surprising, and it's not actually that much if you think about in your own life. But I guess in some ways it does make sense, right? Millennials often have jobs, right? Are of a certain age, have the resources to go out and dine out more frequently than perhaps those who are just starting, for example, in their career.
Well, I am curious also in this, you've been speaking of millennials. We'll just dig on millennials for a little while longer. 79% of them, according to your data, say the restaurant's, quote, Instagram TikTok worthiness matters in where they choose to dine. I'm not actually too surprised. I have a couple friends who are restaurateurs, and this is something they talk a lot about, is how much attention they have to put now into the decor and other non-food elements just to get people in the door. I assume that's been a trend that's been unfolding for some time.
It has been unfolding for some time, and I think if you talk to any restaurateur now, not even the ones who kind of grew up in the age of social media, they know that it's an important part of how diners are discovering them. So whether that be on TikTok or Instagram, but what diners want to know is it's not just how your food looks in a photo, and it's not just about the ambiance of the restaurant, although all of those things, of course, are very important and contributing to a diner experience. But they want to know the story behind the food. Like, why did you pick this cuisine? Why this neighborhood? Why this size of restaurant? Like, I think that's what's really resonating. People want to hear the storytelling from the restaurants. And myself, right, because I didn't grow up with social media, it's been even astounding to see for OpenTable how much people engage with our brand on these channels.
Well, I am curious about that, particularly with regards to your business, to OpenTable's business. You've got tens of thousands of restaurants on your platform right now. I am curious, but we've seen some increased competition from places like Resi and Seven Rooms and a couple others that have cropped up here. How do you make sure you keep people engaged? I mean, obviously you have to get the restaurants on the platform, but how do you keep the average consumer engaged, not just to come to your site to book, but to actually do a little bit more?
There's a lot of things that we do, but first and foremost, what we do is we are a platform for our restaurant partners. We promote and tell their stories. I always tell the company, it is not our job to be cool. Our restaurants are cool. Let us be a tool in which that they can tell their stories. Other ways that, so like, right,
OpenTable is cool, by the way, Debbie.
Oh, that's
I'll say this too, and I'm not just trying to gas you up here, but I mean, you talk about the search functions, which are better than some of your competitors that I won't name, but also the idea of engagement and being able to see what other people think of the restaurants and there, so you have a better sense. If you've never tried it, you get a better sense. Anyway, go ahead. That's my spiel.
You can see. I love that. Thank you, Romaine. You can see the reviews, as you mentioned, right? You can see what other people are saying about the restaurant. We do try to make search and discovery and booking as easy as possible, right? And people talk about that all the time. we've recently relaunched our loyalty program, right? So for those of you who might know, if you're an OpenTable VIP, historically, like no one knew what that meant, and that's fair because we didn't do a great job of showcasing that. So all of that is getting revamped for now. If you are an OpenTable VIP, or we're calling it Gold, you get, for example, 6 months of free Uber One membership, which is a great value and a great deal. You get early access to booking some of the best restaurants that we have in our platform. So we're always trying to figure out and innovate ways to really help our diners, because we know that our number one job is to help restaurants fill their seats. So whether that be connecting with open AI companies, pushing in our social channels the stories of our restaurants, launching Concierge, which is AI search on our own website and apps to help diners get their questions on restaurants answered. All of those things are in service of funneling more guests into our restaurants, because there's nothing worse than an empty seat.
Well, Debby, just quickly here, you mentioned Concierge AI, that is your new AI assistant. I do wonder what uptake looks like, because you think back to Clippy on Microsoft Word, or you think about some of those chats that would open up on travel websites back in the day. A lot of people just X out of them. Are folks actually using the AI search tools?
Katie, I know you're a millennial if you know about Clippy, first of all.
That's true.
I haven't heard that one in years. We have answered millions of questions since the product has come out, and right now Concierge exists on the restaurant profile. So right here, it's not on the homepage, right? So when you go to OpenTable.com or you fire up your app, you actually have to get into a restaurant, and then you can see the Concierge there. We are seeing great usage, and what's really interesting is that when people engage with it and get their questions answered, and you measure the activity that they're doing on OpenTable afterwards, they're more engaged and they're coming back and discovering and booking more frequently when we solve the question that they asked with Concierge. So it's really early days, and we're also trying to figure out how to get it higher up in the funnel. So not just on the profile page, for example, right? But it's front and center when you come to OpenTable.com or go to our app. And all of that is still in flight, and we're pushing hard to do it. But some of the early signals, I think, have been really fascinating in terms of the impact of how sticky it makes our product, their usage afterwards, all of that.
All right, Debby, I have to leave it there. We didn't even get to the top 100 list of the year, which I should point out is dominated by restaurants in my hometown of Chicago. But that's for another conversation. Debby,
yes,
great to always have you on. We have to leave it there. Debby Su, the CEO over at OpenTable. We'll be back in a moment. This is Bloomberg. All right, time now for Factor Friday, where we take a look at some of the big factors that move the equity markets during the week and, well, quite frankly, all quarter long. Chris Cain joins us right now, equity strategist for Bloomberg Intelligence. All right, let's start with the traditional factors, Chris, and kind of what we've seen, not just on the week, but really over the past couple of months.
Yeah, Romain, it's been a choppy trade basically all year for factors, very frustrating, but we have seen some trends emerge, recently. So specifically, momentum has done very well since the beginning of September. We have high momentum stocks in the S&P 500 outpacing low momentum stocks by about 10% over the last, call it, quarter. And then, believe it or not, value has actually woken up over the last 5 weeks. So basically, since the beginning of November, we have the cheapest stocks in the index outperforming the most expensive stocks in the index by about 8%. So that brings values, long, short returns back to about even on the year. Momentum is the leader. So those are really the two factors that have kind of woken up in what has been a choppy trade for factors all year.
Well, let's talk a little bit more about value and what that outperformance has meant for valuations. Where do some of those metrics stand right now, Chris?
Katie, it's the outperformance has been too short. It's only been 5 weeks, so it hasn't really changed valuations. I mean, the thing about factor valuations and value factor valuations specifically, is that cheap stocks are just way, way cheaper than expensive stocks right now, even when you look historically. So basically, when you look at median price to sales of the cheapest versus the most expensive stocks in the index, the cheapest are only about 10% the valuation of expensive. That's much lower than average, actually a 6th percentile relative valuation reading over the last 25 years. we did a study and we looked at every time that value stocks have been this cheap compared to expensive stocks, again, over that 25-year time frame, there tend to be very strong long, short value factor performance over the next year. So we could potentially be setting up for a bit of a rotation.
I have to ask you, though, Chris, about the value trap. When you take a look at the potential return on those investments, are value stocks really, in theory, a better deal relative to some of those more expensive names?
That's the thing, Romain. I mean, the picture is murky because value has a lot of junk right now. When you look at things such as the profitability of the cheapest stocks in the index, that has gone from basically a median ROE return on equity of 20% in 2022 to just 10% now. So a lot lower than expensive stocks. So there is a lot of junk in there. I would say if you're going to be a value investor, you could be a bit, picky as far as what value you invest in.
All right, Chris, great to get some time with you. That is Chris Cain of Bloomberg Intelligence. Now, coming up next, it's the closing bell with Kara Murphy. Don't go anywhere. This is Bloomberg.
One of the things we say, don't fight the Fed, but also don't fight earnings growth. And we look at earnings growth for 2026, double digits. But the good news is it's coming from tech and non-tech parts of the market. So there is this case to be made that you should have some innovation exposure, but you should have some other parts of cyclical and value in your portfolio for the year ahead.
Mona Mahajan kicking us off to the close from Edward Jones just about 50 minutes ago. Looking right now at an equity market on the back foot. The NASDAQ 100 now setting up for its biggest two-day drop in 2 months.
Yeah, a lot of pain coming through in big tech as we sort of rethink some of the AI names here in the form of Broadcom, in the form of Oracle. I will say that 1% drop on the S&P 500, we're now looking at a down week for the big benchmark, off by about 0.7%. And again, this is a week where we hit a record high. We had a Fed meeting, et cetera, et cetera. Certainly, again, feels far away right now.
And it's interesting to put a pin on this, too, because when I kind of saw the sell-off this morning, the first thing you start going is trying to look at all the superlatives. There really aren't that many. I mean, we're only, 1% or 2% below the record highs on the major indices. And while there are some individual stocks and sectors that are kind of in correction territory, overall, this is a market, a sell-off, I should say, that's been a little bit more of a rotation rather than people just cashing in and moving on.
It's a good point. Rotation underway, and we're just churning along near these all-time highs. I'll also point out that it's December 12th. So we're going to see liquidity drop off in a big way when it comes to trading volume. So this might be what the rest of the year looks like. Yeah, so just about 12, 13 more shopping days for Christmas there with Broadcom, NVIDIA, a lot of the big tech stocks on the back foot today. A reminder, we are still seeing some strength out there in other tech names, including Tesla, Apple, and Netflix. Kara Murphy, she joins us now, Chief Investment Officer over at Kestra Investment Management. The count is down to those closing bells. And I do want to start off with the idea of this tech sell-off. We'll just use the word sell-off for now, but the idea that this is more of a rotation, that people may be taking some profits from some of those high-flying names. And if indeed that is true, it does appear some of that money is still staying invested in the equity market. I'm curious as to where.
I think this is very healthy. And it's interesting because I talk to people from all over the country, from high schoolers to retirees to professional investors. And the one question I get the most is about AI. Are we in a bubble? What's going to happen? And I think on a day like today, it's a good example of how we can see the market start to rotate to other areas without AI having to blow up. And this is very healthy. We've sort of been waiting for this for a while. For the last 3-ish years, it's all been about this Mag 7 AI story. And so to see other parts of the market start to step in and carry some of the weight, I think is what we would expect to continue to see into 2026. So,
I mean, when we take a look sort of at some of the sectors that have seemed to have bubbled up, financials gets talked about a lot. I think if my memory serves me correct, I'm pretty sure we hit a record high on most of the banking and financial indices, industrials as well. Are you finding something attractive in those spaces?
Absolutely. So particularly in the industrials, when you look at all of this AI spending that's happening, I mean, the top spenders in the space are spending about $350 billion this year in CapEx. That's an enormous amount of money, expected to increase significantly into next year. And all that money has to be spent somewhere. A lot of it is being spent on building out infrastructure, whether it's data or power or servers. This all has to be built out into real things by real companies, and they have to be deployed. And so that has a multi-year kind of horizon on it. happen. It doesn't happen overnight. And when you look at earnings reports from a lot of these companies, they're reporting huge backlogs, mega projects that will take multiple years to be able to complete. And I think that's a pretty sort of long road for us to be able to enjoy.
And to that point, one of the breaking news stories on the terminal today was that Oracle is delaying some data center projects for OpenAI to 2028. And you have to wonder, Kara, whether we're going to get more of these headlines. Obviously, it's all about the build out right now, but one of the big concerns out there is that when it comes to AI infrastructure, that we're in the midst of an overbuild.
I think that is very healthy that we're asking this question, because the worry is always that there's this huge rush to build out a ton of capacity, and then you get a year or two into it and you find out you don't need it. So then you have all of this dead space. So I think the fact that the market is asking this now, when we're still in the very early stages of building this out, is actually very healthy. I think obviously we're going to have some dollars spent that don't see really strong returns. There are going to be other areas that see stronger returns than what are expected today. And we have a little bit of time to be able to leg into it, but we think we're still in the early innings of that particular story.
I do want to bring the Fed into this conversation because you think about the rate decision that we got this week, the dissents that we got accompanied with that decision, and the silent dissents in the form of the regional Fed presidents. I like this line that you have in your notes saying that Powell is walking a tightrope, as the Fed always is, but this one is more about politics than policy. You consider the politics around the Fed right now and the fact that we're going to get a leadership change in May 2026. How do you approach that from an investor's standpoint?
So, you think that the Fed is always juggling this labor on the one side, inflation on the other. And we're in sort of a unique time right now where you're getting conflicting signals from those two. So we'll admit that this is a higher level of difficulty than some other areas or some other time periods. But when you compare the sort of economic challenge that the Fed has right now to things like COVID or the global financial crisis, the level of difficulty is much, much lower. And to your comment earlier, it's the politics weighing on top of these conflicting signals that are making it so difficult to navigate, right? You have higher levels of dissension from within members of the board. You have this leadership change coming in. You have many more conversations about the administration's view of Fed policy than typically what we've seen in modern history. So those things are going to be much more difficult to actually navigate. Ultimately, what I think that means is that the Fed has to be fairly cautious in how quickly it moves. And we've seen the Fed move in cutting rates much slower than what market participants had expected earlier this year.
Yeah.
I think the caution will actually continue into next year.
Kara, before we let you go, I am curious, and I think the last time we had you on, we asked you about some of the opportunities outside the U.S. I mean, I was taking a look at the performance of U.S. equities relative to the rest of the world, and we kind of forget sometimes that despite the run-up in the U.S., we are still seeing outperformance elsewhere. And I'm curious as to whether you think, A, that continues into next year, and whether, if you're not already exposed to non-U.S. assets, whether you move into that post-haste.
We do think it's very important. And it's interesting when I talk to investors, people don't realize that emerging markets had a really banner year. Non-U.S. developed also had a really strong year relative to U.S. And let's not forget that this is coming on the heels of about a dozen years where U.S. markets outperform non-U.S. markets. So we think this is just the beginning. It's very important to have exposure to both developed non-U.S. and emerging markets. And I think that will be helped by some potentially weaker dollar and some resurgence in earnings in some of those economies.
Carol, always a pleasure. Kara Murphy, Chief Investment Officer over at Kestra Investment Management. And to put a finer point on that, you take the MSCI World Index ex-US here, and the S&P 500 lagging that by the most on an annual basis since 2006.
Yeah, it's pretty amazing. You think back to the beginning of the year, we had that outperformance. Everyone said it wasn't going to last.
Exactly. We move closer to the closing bells here on this Friday. A lot to unpack on the day and on the week. We're going to take some time to do that for you, so stick around. Our global simulcast, it starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell with the global simulcast. We're joined now by Carol Massar and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. We got a lot to unpack here, guys, so light your incense sage, hide the kids. Carol Massar, what do you make here of the sell-off today?
What do I make of the sell-off today? It's kind of these narratives that have been kicking around for the last couple of weeks, right? Concerned about the AI AI spend and build out. I also think the Fed speak has been a little conflicting. And, speaking of that, you guys, I'm sure we're just breaking these headlines from the Wall Street Journal, that the president's leaning towards.
Oh, yeah.
Kevin.
Well, it's a Kevin, right?
It's definitely a Kevin.
It's definitely a Kevin. It's definitely a Kevin. Well, it is definitely a Kevin as far as we know now.
Yeah.
Right?
Well, why wouldn't it not be now?
Well, we all thought it was Kevin Hassett a few weeks ago.
Is
and
it Kevin McAllister? Maybe?
I'm just saying.
I like it. That's a Home Alone reference to everybody out
Thanks,
there.
Tim.
Children of the 80s.
I'm just saying we're going to know when the
real
president
ones.
ultimately makes a decision and says it publicly.
I was just looking at Polymarket because these odds are moving in real time. And just 10 minutes ago, even after the Wall Street Journal story broke, Kevin Hassett was still at 66%. Now Kevin Hassett's down to 56%. Kevin Warsh up to 39% odds. The odds moving just in the last few minutes after this Wall Street Journal story crossed.
Yeah, I want to know what the liquidity looks like in that market.
Volume's $39.9 million.
Okay. I don't know whether or not that's a lot, because it's cool to have that stat.
Yeah. Sorry, I got a little distracted.
Are you placing your bet?
Well, no, I went on to Google here to look up the most famous fictional Kevins in the world. Kevin McAllister does rank up number one.
Good.
Kevin Dominion is number two, in case you cared one way or the other.
So
we don't need
you're
to go through the rest
focusing.
of the list. Let's get you the closing bells here in New York, which not only includes clapping and cheering, but actually confetti there at the NASDAQ, and I'm not sure why, but all of the major indices are in the red on the day, and it looks like mostly for the week. The Dow Jones Industrial Average is going to lose about 0.5% on the day. The S&P 500 down a full percentage point, about 73 points. The NASDAQ Composite, that's your main laggard, down about 1.7%. The NASDAQ 100 down about 1.9%, and the Russell 2000 also pulling back healthily on the day, down about 1.5%.
Also, Kevin Arnold from the Wonder Years.
Yes.
And Kevin Malone, The Office. Did you say that one?
No, I didn't, but I used to love the Wonder Years. Winnie?
Yeah,
I used to have a crush on her.
I know. Who didn't, right? Yeah. S&P 500, guys, almost an even split. 221 names to the upside, Katie. 281 to the downside, one unchanged.
The Wonder Years is also a great band. But let's talk about the circle in front of us. You can see a real mixed bag here when it comes to the sector performance amid this sell-off. 5 managing to finish in the green, 6 in the red. In terms of what did do well today, consumer staples up top, higher by about 0.9%. Certainly a defensive tilt there. Meanwhile, you take a look at what didn't perform, and you guessed it, it's tech, down 2.9% as a sector. Energy and communication services also certainly hurting today, Carol.
Yeah, the SOX alone was down, I think, more than 5% in today's session. So you definitely saw that playing out. Thank you, Broadcom.
It was 5.1% if we were going to be specific.
Okay,
Worst day since October 10th.
I am done. Let's get to some of the individual gainers, if we may, on this Friday. Lululemon, guys, check it out. Top gainer in the S&P 500 and NASDAQ 100, finishing the day with a gain of about 9.6% off its highs, but still nonetheless outperformance there. The shares rallying after the company boosted its full-year outlook, announced its CEO would step down. So as we know, we were breaking this late yesterday. The company looking for a replacement for the company's CEO, Calvin McDonald, who will depart the top post at the end of January. So nonetheless, investors enthused about what's to come next for Lululemon. Hey, also weed stocks, which have been taking a beating, kind of smoking today.
This is insane.
I know. Yeah. Check this out. Canopy Growth up 54% in today's session. That's the ADRs that trade here in the United States. Go over to Tilray. That went up about 44% in today's session. Again, backdrop is that we know that they've been beaten up a lot. So just got to kind of put that into perspective. But what the news is President Trump, or at least he's expected to direct his administration to move to reclassify marijuana as a less dangerous drug, according to people familiar. So pushing to reclassify it as a Schedule III drug.
Yeah.
And that would be really a victory for companies and investors and patients who use medical marijuana.
Did he address the issues that were in that most recent congressional bill that would effectively get rid of like edibles and a lot of other products?
I don't know. Did he?
No.
Okay. All right, so there's more to come, right?
Is that a rhetorical question?
I don't know.
Most of my questions are rhetorical.
I never know when to ignore and when to listen. All right, another group on my mind, fast food, fast casual. Check it out, guys. Let me go through a couple of different names. You have Chipotle. That one is up 3.6%. Shake Shack's up 5%. Kava was up as much as 5.6%, ending the day with a gain of just shy of 1%. Baird analyst David Tarantino seeing these companies as potential beneficiaries from the 2026 World Cup, as you know, being hosted by U.S., Mexico, and Canada. Here's what he has to say. He says the increase in tourism and broader consumer mobility activity tied to each sporting event over the 6-week period will lead to increased spending at restaurants in and around the host cities, and also provide some of these brands a
they want to come and eat that American food, the fast casual that we're known for.
Just saying, eat and go, eat and go. All right, what do you got, Tim?
All right, I got to start with shares of Oracle falling by 4.5%. This after Bloomberg's Brody Ford reported that the company has pushed back completion dates for some of the data centers it's developing for OpenAI to 2028 from 2027. This is according to people familiar with the work. The delays largely due to labor and material shortages, said the people. Oracle, a spokesperson, said in a statement that the company remained confident in its ability to meet its obligations and future expansion plans. And Carol mentioned Broadcom down 11.4%. Worst day going back to January. You know, we spoke to Ian King about this earlier. He said the numbers were fantastic. It was that sales outlook, though, for the AI market failed to meet investors' expectations. Hock Tan said the company has a backlog of $73 billion in AI product orders that will be shipped over the next 6 quarters, but warned that total margins were narrowing because of AI product sales and held off on giving an annual AI revenue forecast, saying it was a, quote, moving target. And finally, shares of Dell falling by 6.2%. This after Business Insider said the company is set to increase prices next week across its commercial product lines. Business Insider cited an internal list of upcoming price changes sent to staff on December 9th. Dell shares down by 6.2%.
All right, a quick check on yields here. It was another interesting day, but more importantly, an interesting week. 2-year yields were lower on the day and on the week, but pretty much across the rest of the curve, we were higher, not just on the day, but on the week as well. In fact, 2 straight weeks now that we've seen the benchmark 10-year as well as the long bond, the 30-year, actually go up rather than down, despite some of those rate cuts.
Oh, so let's go to some stories that have caught our attention. There's a lot of stuff coming at us this week, no doubt about it. This one, though, from Netflix. Lots of malls, department stores that have either shut down and there's been some vacancies. Anyway, Netflix has been turning some of these malls and department stores into immersive playgrounds. So they've got a new permanent brand activation. They've got a movie theater and a retail outlet. It's called Netflix House. It's at the King of Prussia Mall in the Philly suburbs. And so you've got things like a Twisted festival, an escape room, a sports bar. Right?
Yeah, Netflix-themed sports bar. It's all part of an effort to extend the lives of those popular TV shows, create these experiences that are away from the screen for its fans. 2 more locations are planned to open in the U.S., Dallas, and also, you could probably guess, Las Vegas.
It's pretty interesting. I mean, it sounds like a mini theme park housed inside a mall. It makes a lot of sense why they would do something like this. I do wonder what a Netflix-themed sports bar specifically
I want to know what the Squid Game activation is.
Oh, my God. Probably terrifying.
What do you do with that?
You know, speaking of malls, I don't know if you've had a chance. You know, if you go just up here away from Bloomberg World Headquarters, it's the big Ralph Lauren flagship store here. Apparently, Ralph Lauren Christmas, the whole phrase has been trending for quite some time, a reference to, if you've ever seen the decor that they have decked out, the sort of cozy, very sort of rich, homey feel that they put on their holiday decorations, their aesthetic, if you will. Apparently it's taken off, and like I guess everything online, apparently now it's going to consume every single thing that we do this Christmas.
I really love that chart because, I mean, okay, the spike that we're seeing this year is certainly noticeable, but then you take a look, it's so consistent of a bump. Apparently every Christmas, I didn't know this, people really want to know what's going on with Ralph Lauren Christmas.
What I love about this too, and I guess Carol and Tim have no comment on this, but it gets to the idea, though too, I mean, it is very, like it's very, you know, I mean, you know, this whole, it's almost like their normal aesthetic, you know, it's not even just like the Christmas, it's just that now it's, you know, red and green, but it's just, you know, the same, a lot of flannels and patterns and, you know, big leather chairs and fireplaces.
I was going to say they have been, I feel like, selling and marketing a lifestyle for a long, long time. Their advertising has been like that for decades. And so they just kind of amp it up around Christmas. It's kind of like your home, right, Romaine?
It's kind of like...
It's cozy.
No, my home, no. My home's a mess. What's your favorite Christmas movie, Carol Master?
Die Hard.
That's very funny.
I like it.
I have to joke. I end up watching A Christmas Story a lot. It's my husband's favorite, so you know I end up getting stuck watching that.
All right, I'll answer the question
I went to
too.
Cleveland earlier this year, and I went to visit the Christmas Story house. Yeah.
The actual house, yeah.
Christmas Vacation is the best one.
Yeah, that's
National
good too.
Lampoons.
Elf should get a.
Katie, you gonna weigh in? Is it Die
mention.
Hard?
Katie doesn't watch movies.
Not really.
Oh.
I'm more of a 20-minute TV show kind of gal, or a 6-second TikTok sounds pretty good.
I also do love, actually.
Yeah, that's a classic.
I know, it's a classic. All right, guys, that's a wrap. Have a great weekend, a safe weekend. That is a wrap for our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Romaine and Katie continuing there on television. Tim and I continuing right here on Bloomberg Business Week Daily.
When we come back, a closer look here at the market action and a closer look at what to expect up ahead. Jamie Kramer, CIO of Multi-Asset Solutions at JP Morgan Asset Management. She's coming up next. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld. God, it is a Friday,
I'm
Romaine.
Romaine Bostic. It is certainly a Friday, and it's been quite a long week. We started the week with a bit of a sell-off in markets. Things perked up midweek. Maybe some optimism around that Fed meeting, but some concerns about those earnings out of Oracle a couple of days ago, and of course out of Broadcom last night. That took the wind out of the sails of the market rally, taking them off their record highs. The NASDAQ 100 bearing the real brunt of the pain, down about 1.9% in a close today, right around that 50-day moving average. The Philadelphia Semiconductor Index also down significantly, down about 5%, and also firmly now below that 50-day moving average. The momentum trend line on both of those indices now towards the downside. The risk appetite for Bitcoin waning just a little bit, but one of the few bright spots on the day. Carol Massar talked about it in the simulcast. The marijuana stocks having a phenomenal day. In fact, for the Round Hill Cannabis ETF, that's actually the best day on record.
Weed absolutely on fire on this Friday. Let's take a look at why the stock market was down so significantly. A lot of that pain coming through in the tech sector, a lot of that pain coming through in shares of Broadcom, down about 11% after reporting earnings yesterday. You weren't seeing any help when it comes to the likes of Nvidia, too. A big weight on these indexes, off by more than 3%. I did want to highlight one of the big movers to the upside. That, of course, is Lululemon, higher by nearly 10% on this Friday. They have a CEO change that they announced last night, so you can see shareholders cheering that move. But let's talk about our weekly ETF check, and I want to talk about the Dash for Cash specifically. I have on there the top 5 fixed income ETFs as measured by flows year to date. And it's so fitting that up at the top, you have SGov taking in more than $36 billion. This is an ETF that tracks 0 to 3-month treasury bills. It really tells you where the appetite is right now, because you can see BND, that is just a total bond market ETF. It's taken in about $19 billion year to date. Certainly nothing to scoff at, but certainly cash is king right now. Let's talk about that with Jamie Kramer. She is CIO of Multi-Asset Solutions over at JP Morgan Asset Management. Jamie, great to see you on this Friday.
Thanks for having me.
Let's start with cash, because I'm taking a look at the notes you sent over to our producers, and you talk about the risk of being in cash for too long when you think about your long-term performance, but it just seems like it's insatiable demand.
That is true. Like that chart's pretty surprising to me. But when you look at the numbers and you think about why money is going to cash right now, I think people really look at valuations in the markets, and they kind of like are a deer in headlights, but which is what our job is. Which is, if we can get clients invested and keep them invested, all the numbers show that cash is the riskiest place to be in the market. Just think about this year. What's cash up this year?
You tell us.
0?
Yeah, well, no, like we're getting towards the end of the year, maybe about 4%.
Okay, all right.
So what is a balanced portfolio of 60% global equities, 40% bonds up?
A lot more than that. A lot more than 4%.
It's up, like, maybe not today, but let's just say 15%. That's almost the same as the S&P, but with half the volatility.
Right. So it's interesting. I mean, you sit at a very interesting juncture as multi-assets. And I wonder, you know, if you did have a lot of cash just burning a hole in your pocket, and you're taking a look at these valuations across asset classes, where do you think, if you are coming off the sidelines, the opportunity is right now?
Yeah, it's a good question. So it's really hard to say where the opportunity is tomorrow or the next day. But every year we re-underwrite our long-term capital market assumptions. So we'll look at stocks, bonds across not just the US, but the world. And when we use those assumptions, we see a 60-40 portfolio at, let's just say, 6.4%. Now, that's pretty good. But it's down from 7, and you think about where we're allocating. If you're strategically allocating, the areas that we like on a relative basis, we like Japanese equities. We like emerging markets, both in the equity and on the debt. But overall, we're pretty comfortable having a balanced portfolio right now. We had our research summit in London this week, where we re-underwrote our long-term bullish trend for AI. We are believers. Yes, valuations are stretched, but earnings are growing.
Yeah. I'm curious, though, with regards to that 60-40 split, or whatever the split is going to be now, when you start to see people add more alternative assets to the portfolio, is that pulling from the 40 or is that pulling from the 60?
Yep. It's pulling from both.
Okay.
And it depends where you're adding it.
Yeah.
So when we look at portfolio allocation, we think you have to look at the whole entire approach. And for clients who want income, you probably likely are pulling from high yield if you're going to private credit. But what we did is we took a 30% allocation from both stocks and bonds, allocated to a diversified private basket of alternatives. And the punchline is that you can increase your portfolio return and reduce your risk by 25%. So we are believers in long-term alternatives. Now, the difference between publics and privates are twofold. The first is publics, you can get beta. The second is you can get in and you can get out.
Yes.
Privates, you have to really be careful. There is no beta. It's all about manager, which ones you pick. There's a huge dispersion. And if you get into a private equity fund, fairly long lock, even with some of the evergreen structures.
Is that liquidity risk being compensated appropriately right now, or no?
I think it depends. I think in private equity, I would say, and there's different parts of the market, yes, we believe so. Core real estate, we definitely believe so. That's an asset class that provides fairly strong income and is very unloved, so valuations are not rich today. And if you look at other areas, private credit, obviously it's a very large spectrum, but there we're seeing more convergence, and we would have a little bit more caution.
Well, talk to us a little bit about that convergence when it comes to public credit, private credit. You have a lot of issuers bouncing back and forth. Meta is kind of the poster child of that. And I wonder, how you think about that blurring and how you approach it as, CIO of multi-asset solutions.
Funny you should ask. We had a working group today and we were just talking about it. That is the one area of alternatives that we are seeing the lines blurring. Again, we think about if you can build a portfolio that has publics and privates in the same portfolio, it makes sense. And the flexibility as a manager, the flexibility of being able to make decisions if I need a 7% yield, looking at the relative value between the two and then stepping back. So it's not, you don't have to be in one or the other, it's a holistic decision. And that is the area that we think will be converging. We're seeing funds come out in the market that offer both public and private, so you get the liquidity benefits, but you also get to go back and forth where the relative value is best.
What is some of the main concerns that you're hearing from clients with regards to allocating into next year and portfolio construction overall?
Well, I think the number one thing is everyone is worried about stretched valuations. It's hard wherever you look to find markets that are cheap. I think what you would say is that if you start looking under the hood, there are companies that haven't appreciated that much. And the ones that have, some of them at least, some of the large hyperscalers have great earnings. So I think clients are always afraid. In fact, 32 years of my career, every time I've been afraid, you get dips. And then, again, the reason that a balanced portfolio multi-asset works so well is it keeps investors in the market.
All right, Jamie, really fascinating discussion. Great to get some time with you. That is Jamie Kramer. She is CIO of Multi-Asset Solutions over at JP Morgan Asset Management. And for more ETF insights, be sure to check out my newsletter, ETF IQ. That is Bloomberg.com/ETF IQ newsletters. It's not out this week, but I swear it's coming out in the next hour.
So, Katie, what am I supposed to do this weekend? All right, coming up here on the show, AI is taking a hit as those Oracle delays or reports of those Oracle delays rattle some investors. We're going to talk about that a little bit more in depth and the response that we got out of Oracle itself. Stick with us. This is The Close on Bloomberg. Oracle shares, they've been on a downdraft ever since the record high a couple of months ago, and they continue that slide today, down about 4%. The company is said to be pushing back completion dates for some of the data centers that it's been building or said to be building for OpenAI. This according to people familiar with the situation that Bloomberg reporters spoke to. An Oracle spokesperson did respond in kind to that report and said, quote, there have been no delays to any sites required to meet our contractual commitments. Joining us right now is Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. And, whether this is true or not, it does get to an issue that has been raised by multiple people that we talk about all these big financial commitments, but at some point, some of this stuff has to be shovels in the ground. And we know for a fact a lot of shovels have not gone into the ground. How much of a concern, if at all, is this for you, Mandeep, about the potential for delays in this build-out?
Yeah, look, there are two sides to it. One is the supply constraint sides, whether it's power related or just the availability of chips or, have the projects kind of hit the ground and running. The other side of it is the skepticism that investors are showing around the long-term forecast for these companies. And whether it's their backlog number or any other type of long-term forecast, I think right now in the last few weeks, we have seen a lot of skepticism, and for good reason, because if OpenAI is saying we'll be paying, almost half of the revenue we'll generate in 2029, which will be close to 100 billion in compute costs, then the question is, how do they get to 100 billion in revenue, given the compute shortages and, all their business model is around serving the traffic and using these models that are getting increasingly complex. So that's where I think there are doubts being cast around OpenAI's ability to ramp up to 100 billion in revenue. And if they can't get there, then how do they pay for compute costs? And that's where I think the Oracle backlog is getting questioned. But to me, it's all the circular financing and, everything comes back to the model providers eventually.
Right, absolutely. And you think about the circularity of some of this financing, what we're seeing right now when it comes to Oracle, this specific story that they're delaying some of those data center projects for OpenAI. You think about the different deals that have been inked, particularly by OpenAI. Do you see any ripple effects here, should this situation develop further between Oracle and OpenAI?
I mean, look, Microsoft looks like they really did a great job of, refusing some of the OpenAI business, which eventually went to Oracle. And that's how Oracle ended up, signing that $300 billion deal over, multiple years. But clearly, Microsoft had that foresight in terms of, refusing to OpenAI. And to my mind, it sounds like this is going to be a lot more staggered in terms of the build out. And clearly, OpenAI was a lot more ambitious a couple of months back in terms of that 26 gigawatt in additional capacity they wanted to add. But it sounds like until they have revenues to show, it'll be hard for them to, ramp up capacity when it comes to the additional data centers that they want to open.
I am curious, Mandeep, is there an argument? I've heard from several investors, particularly this week, given all the attention around OpenAI and, of course, that big piece in The Atlantic kind of questioning their business model. Is there a sense here that maybe some of the other big AI companies like Anthropic are potentially doing this in a better way than OpenAI?
Absolutely, and that's the challenge of a consumer-facing businesses, because you only have, 4% of your users who are paid users. You're serving, 800 million monthly active users. Bulk of it are freemium. How do you monetize? I mean, Google can monetize using ads. OpenAI needs either an ads or some form of monetization, because the more users use, the more users they add, the more cash they are burning. And that's the challenge of a consumer-facing business. Anthropic, on the other hand, is enterprise-focused, and you get paid for every API call. So that way, it's an advantage for them.
Right. Mandeep, great to get some time with you. That is Mandeep Singh, Global Head of Technology Research over at Bloomberg Intelligence. Coming up, we'll be speaking with Ryan Serhant. He is CEO of real estate firm Serhant. Next. This is Bloomberg. It's an evergreen story. Manhattan rents surging to a record high. Fresh data showing new leases in November were signed at a median of $4,750. That is up 13% from a year earlier. Joining us now, I'm pleased to say we have Ryan Serhant. He is the founder and CEO of real estate firm Serhant. He's also the star of Netflix's Owning Manhattan, which is out now with season 2. Ryan, it's great to see you.
Great to see you.
Let's talk about Manhattan, because we were joking in the commercial break. Has there ever been a period when Manhattan rents aren't rising to a record? But talk us through the specific dynamics that you're seeing in Manhattan right now when it comes to that supply and demand balance.
That's why the show is called Owning Manhattan and not Renting
It's hard to do.
Manhattan. It's hard to rent. For your median apartment in Manhattan right now, there's about 11 tenants who are applying per apartment, because it's too expensive to buy. Rates are not yet at a place where the purchaser can afford the monthly payment, including the monthly HOAs and the monthly real estate taxes, and where sellers, where 90% of them have sub 5% loans. And in New York City, most of the adjustable rate loans, which most luxury markets have, are under 4%, can afford to move either. So all it does is it puts the mobility in the marketplace into leases, and then there's only so much inventory to go around. We have significant regulation now around what can and cannot be built. So most developers who should be building more housing to bring prices down, because that's how you lower pricing, you create more inventory, are saying this is too onerous, and they go build elsewhere.
Do you think those regulations are going to get worse with the new administration, local administration coming in?
Prices are high, not because of the market. They're high because of policy.
Yeah.
Look what's happened over the past 30 years. It's been policy, rules, and laws that have been created by who? By a generation of people who grew up with nothing, who set out to create laws to protect everything. And that's not capitalism, that is asset protectionism. And so the housing market protects stability, right? It protects people who own property already, landlords and homeowners, and it penalizes mobility, people who want to move, who I have a job, I need to move, I need to rent. But you can do it if you pay the price. And so we're seeing pricing go up. Prices will raise even through next year. And it's the same story over and over and over, and then we have a reset and we create more inventory. That's what we need. We need more inventory.
Well, Ryan, something made my week just in the past couple days. I was talking to a real estate agent. I recently moved to Hoboken. I signed a lease. I would love to buy.
I've been following your journey.
I know, actually. I've been discussing it with you. But I was talking to someone, and they said something along the lines of it's turning into a buyer's market. And you are starting to see some softening, at least in my hyper-local area. You're seeing some of the prices come down. I hear what you're saying overall, but, I mean, is there any hope when you think about the New York City metropolitan area that, you know, people looking to buy a 3-bedroom might be able to do so? The tide might actually turn in their favor?
Average days on market right now is sitting at around 50. You've got about 45% of all new listings that have come to market this year have actually come off market. So there's actually a lot of quote unquote shadow inventory that's out there. So if you talk to a great agent, they'll have access to it because it's available for sale, but just not today because sellers are coming off the market for the holidays. You know, they're thinking through pricing strategy. What can they afford to actually sell for? So I don't think it's a buyer's market per se. You're not coming in and getting 10, 20% off. It's not necessarily also a seller's market where you're sitting there and you're saying, all right, I'm going to take my pick of the litter. I think it's an opportunity for it to be everybody's market, right? If you're a buyer and you can afford the property, you can make an offer, you can negotiate, you can get a good deal. If you're a seller and you're realistic on price, you will have buyers and you can sell pretty quickly. It's only when you have, you know, sellers or buyers who both think that they're the smartest person in the room, that's when each one says, bah.
Yeah.
I am the smartest one in the room.
See, I told you, we all are.
Yeah, and realistic pricing, that's something, that's a novel concept. I do want to talk a little bit about Owning Manhattan. The second season came out. I watched the trailer. I haven't had a chance to actually watch the episodes yet.
You better this weekend.
I feel like it should be called, based on the trailer, it seems like it should be called Fighting Manhattan. What is going on with your agents and all the people out there right now?
Listen, It is a realistic depiction of what it's like to sell real estate with your shirt off. No, I'm just kidding. To sell real estate and build a real estate company from the ground up in New York City. And it follows that process.
Yeah.
It's also a reality show. It follows the drama, you know, and they film us in real time for 6 months. And then they capture the best moments and they edit it down into 8 38-minute episodes.
Yeah.
It is a lot. It is fast. It's dramatic. It's incredibly emotional. If you like that type of stuff.
Yeah. Well, yeah, it's fun to watch. I don't know how real it is, but
it's super.
fun to watch.
Let me tell you. Compared to other real estate shows and other reality TV shows, this is the most real because it's my life. I live it.
Yeah.
And the drama there and the altercations, they're real and they've been in the press, so you can like follow along.
Yeah. I am curious, though, one thing about the show, and obviously it gets edited down tremendously, but given that you're dealing with a lot of high-profile clients and other people who maybe don't necessarily want their faces or names even associated with it, how do you sort of navigate that and sort of being able to do your show and at the same time serve people that maybe want a little bit of privacy?
For people who want to go on camera, it's easy because they sign appearance releases, the properties sign location releases, and you're good to go. We do follow deals. For example, there's a deal on the show this season for $60 million. It's the sale of an apartment in the West Village. At the time, it broke the Lower Manhattan condominium price record. The entire transaction is followed. I actually had a buyer, and he got screwed out of the deal, and they followed that process too. The sellers did not go on camera. The buyers didn't go on camera. The agents and the process are on camera, and that's where you actually get the most meat of the story. So there's a lot of that, right? We ask people if they don't have to. The show, though, brings an insane amount of exposure to Serhant, to our firm. I mean, our listing traffic goes up something like 3,000%, right? I mean, Netflix is in 200 countries. There's tens of millions of people who watch the show right now. Maybe not you yet.
Yeah,
you're going to watch it this weekend.
Do you know Netflix has this whole experience saying like they have a Stranger Things theme park now out in King
they're Netflix houses.
Yeah, Netflix houses. Have you spoken with them about, because, I mean, you sell houses.
I do.
I would think that would be a natural segue, the Netflix house, Serhant house or something?
Yeah, we have Serhant houses.
Right.
I love it. They have yet to open one in a location that is very nearby me, so I'm excited to go see one. They opened one up in Philadelphia first. I believe they have a Dallas one now. Vegas one coming. But yes, I'm all over them, letting them know, hey, you guys are buying HBO, buying real estate. I'm here to help.
I mean, they got $80 billion laying around, you know?
Yeah, there you go. Ryan, it's always great to get a check-in with you. I think so.
You don't have another question?
I have a producer in my ear saying that we should wrap.
I had another question.
Well,
you don't want to talk about your housing journey anymore?
I have so many questions, but most of them are off.
Yeah, I can ask him about his T-Mobile partnership.
Do you want to tell us about it?
We can talk about T-Mobile, sure. Yeah, we broke the internet 2 days ago. We put together the first of its kind deal in the real estate brokerage space, where we're partnering with T-Mobile to bring something called Super Mobile to all of the people who use our app, which is called Simple, which is an AI operating system for salespeople. It replaces all administrative work. And so now everyone who uses it, their cell phones don't have to ping cell phone towers and wait in line like the rest of us. So even in New York City, your signal goes down, right? You'll be on like 55th Street and all of a sudden you have no service. So with Super Mobile, that doesn't happen. It's really, really cool. It's really wild. And it's been a lot of fun, and it's been a great, great partnership to have. It's a couple days old, and I'm excited to see it roll out.
All right, Ryan, always great to talk to you.
Thank you.
Best of luck to you, Ryan Serhant there, the star of Netflix's Owning Manhattan, and of course the founder and CEO of the real estate firm, Serhant. We'll be back in a moment. This is Bloomberg. All right, welcome back. Our next guest built his brand by building businesses, from his track record at the Essence magazine to his New Voices VC fund, and a new one aimed at amplifying smaller, diverse entrepreneurs. I had a chance to sit down with Richelieu Dennis. He's the founder and chair of the Sundial group of companies, sold his Shea Moisture company back in the day for a cool $1.6 billion, and now trying to help out other entrepreneurs do the same. Take a listen.
We're entering a world now where everything is changing, right? Everything is shifting. And within that shift comes opportunities, right? And so there's the world that we used to live in from an entrepreneur perspective, from a fundraising, from a capital, from a stability, from an ecosystem perspective, that is undergoing a tremendous amount of shifting, right? We're seeing what's happening with Black women and their jobs, and the losses of jobs. We're also seeing that Black women are driving the growth of new businesses in this country and driving the levels of entrepreneurship, but are also impacted by the lack of VC capital that's available and that's going to them. And so there are constraints, but within those constraints come new opportunities. And so our job is to help them navigate this new environment, help them get settled in where they are with their existing businesses, and then find new entrepreneurs and new opportunities for both the existing businesses and new ones. So it's fun.
Is the support there for them? I mean, it's funny, you talk about Black women and the entrepreneurial streak. I feel like this is a conversation we could have had 50 years ago, 100 years ago. I mean, obviously, your connection to the beauty industry, there's a long line of Black women who were basically shut out of other opportunities, and they found their own opportunities. Why is now different than then?
So I think now you have a few things that are structurally different, right? Then there were a lot more avenues in terms of new job opportunities opening up. We see the areas that they've been focused in, whether it's in the medical arena, whether it's in the legal arena, whether it's in the marketing arena. So those avenues were opening up back then, whereas those avenues now are shrinking. Right, so you're seeing when I talk about the job losses, you're seeing that Black women are disproportionately affected or impacted by those job losses, right? And so I think what's different about it is the structural changes that are going on. Also, what's different about it is that they've now had a tremendous amount of opportunity to exposure, right, and to see how things run, how things shift, how things change. And because they're the culture drivers, applying the understanding of what drives culture to those experiences that they've now had, I think is also helping to fuel that entrepreneurial spirit being exercised as opposed to just living within. And then the third thing is they've seen some success, right? You've seen companies like the Honey Pot with Beatrice Dixon. You've seen Monique and Mayel. You know, you've seen successes now that they can look at and say, hey, I can do that too, right? Like I've seen somebody start from scratch, start from the kitchen, start from the garage, build something, and I'm part of that build. And so I think you're also seeing some confidence that comes out of seeing others do it and be successful at scale.
On the capital side, I am curious, particularly when it comes to consumer products companies. I've heard from a lot of venture capitalists this idea that a lot of them won't even sort of take a meeting with some of these companies, certainly not at the early stage, maybe when they're very mature and have a track record. Is that an impediment when you're dealing with these consumer product companies as to like how early are you comfortable getting involved with them, meaning making an investment?
Yeah, I mean, it's absolutely an impediment, right? Because as my mother always says, nothing happens until something happens, right? And so great ideas out there, great solutions to serious problems. A lot of times, the capital doesn't understand the problem that you're solving, because most of the time the problems that we're solving are community-based problems, right? They're happening in our homes, they're happening in our neighborhoods, they're happening in our schools, they're happening in our churches, they're happening inside of our environments. And so a lot of times the capital doesn't understand that. More than that, a lot of times the capital is saying, hey, I'm more familiar over here, right? Or I know so-and-so, I have access to so-and-so, so that's where the focus is. And so the challenge is to get pools of capital that understand these solutions, right? Understands these problems and the solutions that are being provided.
Are you seeing more firms falling into that category, meaning newer firms, or at least firms that are represented by people who look like you?
Unfortunately, not, because at the higher levels, the capital has dried up, right, for those purposes, right? And so what you're seeing is less and less fund-to-fund activities going in here. So which means the ones that do have the resources, those resources have become more precious than ever. So deployment has become more stringent than ever. And so what you're finding is that there's less and less risk to be taken at the seed stage, at the incubation stage, and more folks are waiting to see where you land in your Series A. And what we found over the years is even when you get to a Series A and you get something that's functioning, it's still difficult getting that Series B and then getting to that Series C. So our job is to make these companies exceptional from the beginning, so that when they get to that stage, it's now a level playing field, and you're really now just looking at the math as opposed to, hey, do they have the right team? Do they understand the market? Can they scale? How much time is this going to take from us in order to make this happen?
Our conversation with Richelieu Dennis, the founder and chair of the Sundial Group of companies. And you can actually watch the full interview by going to Bloomberg.com/live/shows and navigate to the close, Katie Greifeld.
Yeah, seamless process. It should only take a couple of minutes. Still ahead, the business.
Can we just put a QR code up on the screen or something like that?
That might be easier. We're working on it. Still ahead on the close, the business of reverse logistics is booming. We'll hear from ReturnPro CEO Shamiss about how the industry is navigating tariff and consumer crosswinds. This is Bloomberg. Time now for Next Up, where we highlight the entrepreneurs and trendsetters moving the needle in business and the economy. Today, we're talking reverse logistics. That's the official term for the chain of events that happens when you return that impulse purchase. Our next guest is just out with his annual holiday returns report and says that stakes have never been higher for his reverse logistics business. Joining us live in studio, I'm pleased to say, is Shamiss. He is the co-founder and CEO of ReturnPro. Sender, great to see you in person.
Thank you very much for having me on.
So let's talk about these stakes this specific holiday season. Why are they this high this holiday?
So first of all, as always, the return rate keeps going higher and higher. This year it's over $800 billion, over 16% of everything sold. The goal at the end is to make sure we bring that product back to life and kind of get it back on the shelf. This year, I think more than any other year, most of the retailers and brands we work with have focused on tariffs, and our job is to make sure they pay as much attention to returns as they do to tariffs. And of course, last year it was a really important thing. I'm not saying it's not important this year. I'm just saying that some things did take a back seat to tariffs themselves. So from our perspective, it's time to bring attention back to those returns, and it's very important to solve the problem.
So you work with retailers to help them manage that process. Let's say that, something goes amiss. I mean, put it in concrete terms why this matters for retailers, if they don't have a smooth process to actually handle the returns that they're getting.
So first and foremost, I think the most important thing to point out is the fact that returns represent such a huge percentage of the sales themselves, that 16% I talked about. But more importantly, 50% of consumers care about returns. That's a really important part of the return journey. They just won't shop at a retailer if they don't have a good return solution. Additionally, with things like AI, over 50% of consumers we surveyed used AI this holiday season to shop for their holidays, and there aren't any good return solutions that are doing that reverse kind of generative conversational AI, but for returns. There's a lot for shopping, but there isn't a lot for returns.
I am curious as to how you vet the goods when they come back, because obviously you have to make sure they're still in the new condition, or at least the condition that the retailer or the brand requires to return. But there's also the issue of the origin of the good itself, whether it was actually indeed bought from the retailer or whether it was acquired through theft or some other means.
So we do this for the largest retailers and brands. We do it for tens of thousands of brands and retailers such as Walmart. The brands themselves have different kinds of policies with the retailer themselves. So in a lot of cases, they'll ask for that product to be shipped back. If it is an international item, like we were talking before the break ended, the item actually physically has to be returned to that country of origin. In a lot of cases, that headache is just not worth it. That transportation cost is not worth it. So maybe they'll let a customer keep it. Maybe they'll get a company like us to try to bring it back to life. We have we have basically thousands of teammates. We have locations in Canada, United States, Mexico, Southeast Asia. The whole purpose is to bring the product back to life and put it back on those marketplaces. And it's not just the people doing the work. It's the technology that it takes to put together that entire ecosystem to get that product back to life.
What have you done to improve your own technology internally within the company to sort of make this process not only easier on your clients, but I guess more economical for you as well?
So our software, our SaaS, is actually multi-phased. We have an internal component that works with the retailers themselves. So imagine a portal in POS, like in the point of sale systems. Imagine a portal online that allows the brands to physically let us take over the returns process. But then there's software that's in the warehouse that specializes in returns management systems. There's software that specializes in putting that product back on their marketplace. That's basically the gist of it, but there's a lot of nuances within it, especially lately with AI.
Oh, yeah.
And Sandra, we only have less than a minute here, but I do want to go to this finding in your annual holiday report. Caught my eye that fraud risk continuing to rise. 75% of retailers say that return fraud worsens during the holidays. What does that actually look like? People are trying to return things that they didn't actually buy?
So about 150 billion out of that $850 billion number is fraud. And there's two types of fraud. There's organized fraud. There's just like your regular consumer saying, you know, maybe this item's not what I wanted. Maybe they're wardrobing, which means they're buying an item, wearing it, and returning it. There's a lot of different types of fraud. The organized one is the dangerous one. And it's just a terrible thing that needs to be resolved, and we do it.
All right. Well, obviously a busy time of year for you, the holiday season, and more importantly, the post-holiday season. Senator, always great to catch up with you. Senator Shamiss is the co-founder and CEO of ReturnPro, a company that helps all of those retailers and brands deal with all your unwanted holiday gifts.
Yeah.
Katie Greifeld.
Certainly a lot of that, I'm sure, to sort through during the holiday season and immediately after.
Yeah, and well, speaking of the holiday shopping season, we did get a chance to catch up with the CEO of Macy's, Tony Spring. A special conversation with him that will air tonight on Wall Street Week. That airs at 6 p.m. New York time. That does it for us here on The Close. Katie and I will be back on Monday. But for all your politics coverage, stick around. Balance of Power is up next.